This is the price of market returns. The fee. It is the cost of admission and it hurts. Like most products, the bigger the returns, the higher the price. Netflix stock returned more than 35,000 percentage from 2002 to 2018, but traded below its previous all-time high on 94% of days. Monster Beverage returned 319,000 percentage from 1995 to 2018, among the highest returns in history, but traded below its previous high 95% of the time during that period. Now, here's the important part. Like the car, you have a few options. You can pay this price, accepting volatility and upheaval, or you can find an asset with less uncertainty and a lower payoff, the equivalent of a used car. Or you can attempt the equivalent of Grand Theft Auto. Try to get the return while avoiding the volatility that comes along with it. Many people in investing choose the third option, like a car thief. Though well meaning and law abiding, they form tricks and strategies to get the return without paying the price. They trade in and out. They attempt to sell before the next recession and buy before the next boom. Most investors with even a little experience know that volatility is real and common. Many then take what seems like the next logical step, trying to avoid it. But the money gods do not look highly upon those who seek a reward without paying the price. Some car thieves will get away with it, many more will be caught and punished. Same thing with investing. Morningstar once looked at the performance of tactical mutual funds, whose strategy is to switch between stocks and bonds at opportune times, capturing market returns with lower downside risk. They want the returns without paying the price. The study focused on the mid 2010 through late 2011 period when US stock markets went wild on fears of new recession and the S&P 500 declined more than 20%. This is the exact kind of environment that tactical funds are supposed to work in. It was their moment to shine. There were, by Morningstar's count, 112 tactical mutual funds during this period. Only 9 had better risk-adjusted returns than a simple 60-40 stock bond fund. Less than a quarter of the tactical funds had smaller maximum drawdowns than the Leave It Alone index. Morningstar wrote, with a few exceptions, tactical funds gained less, were more volatile, or were subject to just as much downside risk as the hands-off fund. Individual investors fell for this when making their own investments too. The average equity fund investor underperformed the funds they invested in by 0.5% per year, according to Morningstar, the result of buying and selling when they should have just bought and held. The irony is that by trying to avoid the price, investors end up paying double. Back to GE. One of its many faults stems from an era under former CEO Jack Welch. Welch became famous for ensuring quarterly earnings per share beat Wall Street estimates. He was the grandmaster. If Wall Street analysts expected $0.25 per share, Jack would deliver $0.26 no matter the state of business or the economy. He would do that by massaging the numbers. That description is charitable, often pulling gains from future quarters into the current quarter to make the obedient numbers salute their master. Forbes reported one of dozens of examples. General Electric for 2 years in a row sold locomotives to unnamed financial partners instead of end users in transactions that left most of the risks of ownership with GE.